Hi, everyone. Hey, thanks for joining in. How's everybody doing? I figured we were probably going to get more people on Zoom today and instead of in the office and so, but that's quite all right. Okay. I think Amanda's going to get the link and everything up and going. So I see we got Danielle, we got Mr. Drev. How you doing? And Angela's on. So hi, guys. And then we'll get some things started in just one moment. All right, let me see if I can. Share my screen. Okay. All right, guys. Can everybody see my screen? Just give me like a quick yay or a thumbs up. Okay. All right. Perfect. All right. All right. Give me one quick second. I'm going to go shut this door. Okay. All right. Well, good morning, everybody. Thanks for joining in on this quick Zoom meeting here and office meeting here that we have in regards to knowing your credit score and debt consolidations and everything like that. Um, what I wanted to kind of really discuss today was just kind of going over, just a little bit about credit repair, in general, and the things and the steps that we do each and every day when we're reviewing a customer's or a borrower's, I should say, credit analysis and seeing what's on there, if there's any issues and what needs to be, updated, like if they're having, problems getting certain things off their credit report, or just to kind of give them a general idea of what they need to do to help increase their credit score. Okay. And so we're really going to dive into this more here next month when we have our CE class, because I actually have our our credit repair people that we work with at Credit Repair Services are going to be doing a credit repair class coming up, and it's going to be on March the 7th. So mark your calendars now. You definitely want to make sure and be here for that. They're going to dive even further in the whole credit repair process, and it's a 1 hour CE. We're going to have food and everything. So mark your calendars for that. It'll be, I think it's a Thursday, March 7th, and it'll be from, I think it's 12 to 1:30. So, but we'll send out, an invite here soon. I know Amanda's working on that for me to get that ready to go. So, but just wanted to, give you guys a quick update on that. But as you guys know, especially in the mortgage sides of things, the credit score is, still one of the top factors and what it takes to, to get a borrower, approved for financing. Obviously having a great credit score is going to open the door up for a lot of things, and not just, a lower interest rate and things like that, but it's going to open up the door to maybe other products that are available, any kind of maybe extra assistance, whether it would be down payment assistance, things like that. All those kinds of things are going to be are part of, having, strong credit. Okay. And so first, what I want to do is I'm going to start with this right here, this particular form here, because this one's a good one to kind of know, to kind of go over, the basics on what really moves the needle in regards to credit repair, and what factors really play into that when it's generating each and every score between the three major credit bureaus. Okay. And so this one's just a great informational tool that I have. I have these available in my, Total Expert system that I can even, co-partner with you guys if you ever wanted to, send out something like this to your borrowers. We can co-market something like this just to give them a nice informational tool to kind of read and, open houses, things like that. It's just great to put in, your open house packets and things like that. But it's basically just going over everything to do with the credit score. So as you can see on here, it says your credit score is tremendously important when you're buying a home. Learn what factors, make up the score and how keeping it strong can help qualify for a mortgage. And so, obviously, paying your bills on time is obviously the number one factor. I mean, when you have an underwriter, that's looking at a borrower's file, when they take a look at the credit report, everything that has to do with getting somebody potentially qualified for a mortgage, has everything to do with their basically their track record to show their ability to repay debts. So paying your bills on time obviously is a huge impact on the credit score, and any debts that haven't been paid in 30 days or more, can lower their score as much as 10 points. That's another thing I like to let people know, in regards to if they do have anything late. I get questions asked, all the time. They're like, okay, Cliff, I was, we were out of town. We were either on vacation or, something came up and they were just like 10 days late on making a payment to their credit card. I'm like, that kind of stuff is okay. I mean, because by law, whoever the credit agency or whoever the debtor is, that the borrower either has a loan out with, or if it has, any kind of outstanding balance, or anything of that nature, they cannot report anything negative to the buyer's credit report, okay, until it is after that 30-day period. Okay, that is basically their grace period. So I know maybe even on their statements, they say, hey, your bill is due on the 5th of every month. Okay. But you don't pay it until like the 11th. They still can't go, if you make your payment and get everything registered within that timeline, as long as it's before 30 days, they cannot, report that to the credit agencies as a negative, late amount. Now, they may charge like a late fee, in some cases, if there's a creditor that's out there, or whether it would be some kind of installment loan, or if it's something that, the borrowers either took out as a personal loan or student loan or anything like that. If they don't have a grace period for you to make up that, make that payment, then they can absolutely charge you a late fee of some kind. And then that would have to be paid along with, whatever the normal payment is to make sure that everything is good and current for that month. Because if they say, for instance, you do make your payment, but they did charge you like a $25 late fee and you didn't pay that, then that opens up the door where they could potentially say, hey, their monthly payment was not paid in full on after that 30 days. I mean, it's very rare that would probably happen, but in some cases, depending upon who the agency is, they do have every right to potentially, mark that as a late payment if it was not totally done at that time when the month was due. So just to try to give you an idea of, how that works with paying the bills on time. And if you're late, there's no necessarily need to totally freak out about it. As long as a payment is rectified before that 30-day period, they cannot mark anything negative on your credit report. Okay. Now, the next one here, and this is a really good one, is to try not to close all, the accounts, especially, because it's just an important, to kind of have that, open trade line. So a lengthy and well-managed credit history will help your credit score. It actually helps it pretty tremendously. If you have a number of credit accounts, keep the old ones open and active. I know a lot of people, when they pay off debts, okay, whether it would be credit cards, installment loans, any kind of loan, personal loan, anything that's going to report to their credit report. Now, loans are different as opposed to credit cards. When you pay a loan off, okay, great. You still have that pay history from when you started paying on that particular account all the way through to that last payment. So, and then once it's paid in full, and then if it does come off the credit report, and at that point, that's still not necessarily a bad thing. It just means that that term is up, and it could adjust the score, I'd say maybe by a couple of points. Normally, like if people have a car loan, say you have a car loan that's out there and you've paid it off and you're excited, everything's great, and then you see your credit score drop, once it stops reporting by like 5 points. That's not necessarily a bad thing. It just means that that particular account is no longer reporting on-time payment history, okay, through, on the credit report. So, and it'll take another month or so for you to get those points back, but it's definitely something that's a good thing, because those points will come back after the next credit cycle. So just to kind of give you an idea, about that's not a bad thing. The important thing that they're really trying to, take a look at is keeping some credit cards open, because I know a lot of people, when they get their credit cards paid off, they want to close them. They're like, just so they don't run them up again. It's all about having that discipline and just the management of your finances to keep some of those trade lines open, especially if it's a credit card maybe that you opened a few years ago and you maybe use it frequently but pay it off. Those kinds of things do absolute wonders, for your credit report. So it's always good to kind of keep those positive trade lines open and available, because it just does nothing but help you. So the biggest thing, again, when it comes to credit cards, is that they can truly be, your best advocate for your credit score, if you use them the right way, which means you really want to try to keep them below, I would say, I know on my form here it says keep balances below 30% or more. I mean, I think it's more about 25% where you start to see, the biggest, increase in effectiveness, to these credit reports doing wonders for your credit score, is keeping it right around like the 25, I'd say around the 25% balance of, what the account is. And to give you an idea, so say for instance, if you've got a credit card that has $1,000, credit limit on there, okay, you want to try to keep it at any given time, the balance under, say, $250, because that's your 25%. Okay, so just to kind of give you an idea of what they mean in that regards. So but yeah, definitely keep those credit cards open. If you want to close a couple, that's great, but you'd always want to make sure you have at least 3 open good trade lines. So if you got like 10 credit cards and you want to close a couple, that's fine, you know what I mean? So, but the ones that you maybe have had open the longest, you might want to think about maybe just keeping those up. Just keep them with a 0 balance, but keep them as an open account. Okay, because I know in some cases, if some credit cards that people that are open and they don't use them, sometimes whoever that company is will just close them. So it's always good to maybe use them, maybe just to get gas, or if it's like some type of credit card that you at like a National Tire and Battery, or Lowe's or something like that, and you wanted just to kind of keep it active, maybe just go, and if you need to get something, go use it, put it on that, and then just pay it right off. And then it'll trigger it, and at least it'll show the company that you have been using it within, say, a 12-month calendar year, and they may keep the account open. So, but those kinds of things, that's why it's nice to kind of you be in control of it, instead of the people that are whoever that particular creditor is, to just to have the ability to close it or not. You want to make sure you keep your accounts open on your under your control and not theirs. Okay, next is the minimized credit application. So don't apply for credit you don't need. Each time you submit a credit application, a lender requests to view your report, which can reduce your score. So now what they mean by this is especially during the mortgage transaction. Obviously a mortgage company, the only time that they're ever going to be involved and want to be complacent with the borrowers and have an understanding is if anything is opened during the course of a mortgage application. So say you got a buyer, one of your buyers is under contract, and they are looking to, and say all of a sudden the car went out, they need to get a car loan. Okay, because at pre-approval process, I am always preaching like, hey, do not open any new debts or open up any trade lines, throughout the course of you looking for the property, and then once you get in your home and your loan closes and your loan funds and you got your keys, then you can go open new trade lines. But sometimes that's not necessarily realistic all the time. Sometimes life happens, and the car breaks down, or something happens where they just need money that they don't have in their checking or savings account. They need to get some kind of personal loan or what have you. So when these kinds of things happen, we always get an alert, because during a mortgage transaction, okay, the creditor, the borrower's credit report is always open for alerts. And what I mean by that is, if anything's opened or their credit score was pulled, we will instantly get notified until their loan is closed and done. After they close their loan, it immediately shuts off as far as the credit monitoring. But during the course of the application, we have to have that open for compliance purposes, to make sure that people don't go out and buy outside their means and really affect their approval. And so basically why we always preach this, again, is just to have people have the understanding where we try to don't let them or to tell them to don't open new trade lines, just because we don't want anything as far as a new payment to affect their possible approval. And so, but this could have a big effect too when you're having multiple credit agencies pooled. Now, another important factor is during the mortgage process. Okay, so if you got a buyer that is maybe shopping, if they've checked with their bank and they've checked with me and they checked with another lender, those kinds of inquiries are fine, especially if they're done within a 3-week period. That's really like the sweet spot. You get a 3-week period in order to rate shop if it's a mortgage related inquiry. Okay, those kinds of things are okay, and it won't affect the credit scores. Now, I know in some cases, if a borrower, say, has their credit pooled, to go get a credit card, or say they were at Sam's Club or I'm sorry, or like Lowe's or somebody like that, and they wanted to open up a Lowe's card or something like that. Now, those kinds of things will affect your credit score if you have them done within a 30-day time. And those are different. So those kinds of inquiries that are not mortgage related will lower the score if they're done around the same time. So we tell people to try to be mindful of, minimizing your credit applications until, your loan process is done and you own your home, and, then you can go get what you need to get. Okay. And then lastly on here is, kind of touching on it again, is keeping your balances low. Your credit score evaluates your total balances in relation to your available credit. Okay. This is called credit utilization. Try to keep the ratio at or below 30%. I'd say 25, but 30 to 25% is where you want to kind of keep that at. So, this information is really good for borrowers to kind of have a general understanding of what factors can change or better or worsen, their credit score. Those kinds of things just are just important to know. I mean, you'd be surprised, what some questions that people ask me in regards to credit reports, and people that just don't understand, or when they're going to get pre-approved and they don't understand or realize that they had a 580 credit score, those kinds of things. It's just, man, it's just a big wake up factor, and I just really try to educate and help people to understand, the things that can cause their credit. Now, for the most part, most people that I talk to have at least encountered or had touched base with a credit monitoring kind of system, like you have, like the Equifaxes or the Experian apps, the Credit Karmas, of the world, those kinds of things, to at least kind of see what's going on. Because sometimes, there's a lot of times that borrowers will see a collection on their credit report when they're going to apply for something because they need some kind of financing, and they're like, hey, wait a second, what is this? I didn't know anything about that, and then now we're having that conversation where, I'm pulling up their credit report, I'm going over things with them to show them that, hey, this is what is on your credit report that shows that it looks like it just got put on there, that was a medical collection. And those kinds of things, could have an impact on, their credit score. So education is key, is just letting people know and to be aware of what's going on with them and their credit report. And, just so they have a general understanding, it's not like they need to go pull their credit report all the time. They can use one of those monitoring systems so they can at least go in and check and see what's going on with it. So they're educating themselves to get them in the best situation possible to have, a good credit score. So I just really wanted to touch base on this. But before I move on, to some of the other steps, is there any questions? Do you guys have any questions about anything in regards to, what we just discussed so far? Credit repair. Here it shows you the payment history is the biggest piece of the pie. Your on-time payments is great. As you can see, 30% here. Amount owed is the other large factor is what you owe as far as like on your balance is low, credit history, new credit and credit types. All those are really minimal. They have an effect, but not as much as the payment history and the overall balance in your credit utilization. But yeah, any questions? Yeah, please, if you have any questions, just stop me, unmute, or whatever you want to do, and just interrupt me and let me know if you have anything. Okay. All right. All right, so we'll go ahead and move on here. So I'm gonna pull up here next is, just some more information, some more good information on, credit repair tips, to getting yourself mortgage ready. And this is what I always try to, send this over to borrowers just so they have an idea of kind of what to expect and, what can really kind of factor in them being a very strong, borrower, for the program they want to get qualified for. So 8 credit repair tips for getting mortgage ready. Okay, so for some home buyers, credit repair is the first step toward mortgage approval. A higher credit score can result in several benefits, including lower mortgage payments and an increase in chance of your loan application will be approved by an underwriting. So knowing what to expect will help ensure that they can reap the rewards of better credit. And here are some steps that I have put together here, to let people know that, hey, this is really going to benefit you, for the mortgage process. And this is basically getting these clients mortgage ready. Okay. First, I always talk about, I'm like, just do your research. Knowledge is power, especially when it comes to, your financial situation. Talk to a financial professional like myself and your credit issues and qualifying limitations. This is something that I really pride myself on when going over these things with clients and having them tell me, okay, what are you comfortable with, paying each month? Because when I'm getting borrowers pre-approved, it may be that they, maybe qualified potentially more than what they actually want to spend, like in their budget, and what kind of impact is this going to help on their overall, day-to-day, living expenses. So we always make sure that I always try to go over and talk to them about, hey, let's look at what are you paying on your credit cards each month now that we're factoring in a mortgage payment. How is this going to work with your monthly income and each one of your bills going out on a monthly basis? So we really try to discuss that and kind of go over those kinds of details up front with the borrowers, just to make sure that they understand what they're getting into in their situation. And then number 2 is just start saving. Beyond having a strong down payment, there are also other out-of-pocket costs to consider, especially during the process, homeowners insurance, closing costs, taxes, those kinds of things. When you're meeting with your clients, when they have home inspections, all those kinds of things, it's just nice to kind of have that understanding and what to expect up front, instead of, because nobody wants to have that uncomfortable conversation where, hey, yeah, you want to get the inspections, and well, here's the amount, here's the cost for those, plus you got to factor in, do you want, appraisal costs and your closing costs and those kinds of things, and then having money left over for stuff you may want for the house, and all those kinds of things are what I always make sure to kind of discuss and kind of talk to, clients that are looking to get pre-approved, so they have an understanding of the whole overall process and to kind of get them, like I like to say, mortgage ready. Okay. And then number 3, this 3-digit number is basically what the creditors use to determine what your interest rates, is possibly going to be and the ability to repay your loan. A higher FICO score, which is a higher credit score, means faster loan approval and better interest rates. So this is just kind of touch bases with, back to what we talked about first, is knowing your credit score. It's just, having an idea of where you're at. So when it is time for you to, to get with me and get pre-approved, and to get with you guys for you to show them a house, that they're ready to go and they're going to be in the best spot possible. Another reason why it's good to, have strong credit score too, is the types of financing, because as you know, especially over the last few years, um, having trying to think of what it would be. I would say, let's think of the best way to kind of, to break this down. I would say just overall, as far as like cash offers and conventional offers, I'd say the last, couple of years alone, they, conventional financing just seems to be the option of choice, and just overall too, because I think it's because of, the least amount of, restrictions, and like the way the property is and all those kinds of things. All that, it's just a little bit lesser, option, I think, for sellers to possibly consider, just because it's not as strict. I mean, everything is health and safety focused, but it was, for the most part, having, that I would say having at least that option other than cash options seems to be the best, ones going forward, that they have. At least we've noticed over the last couple of years. So a stronger credit score is definitely going to get a borrower, a better chance of getting approved for a conventional loan, as opposed to, FHA or VA, the other programs that are available that are not as credit score focused. So, just to kind of give you a general understanding in that regard. And then, as it says, number 4, it says check your credit. You'll also need a copy of your full credit report with all 3 of the major credit bureaus, which are, I should say, Equifax, TransUnion, and Experian. While you review, take note of how much you owe in total, areas to improve, any inaccuracies, and whatnot. So that's another thing that one looking to get a borrower approved is. I think that's why they do have the 3 agencies, because they go off of the average of the middle score. So, if a borrower has a 700 credit score for, at Experian, and 680 at TransUnion, and a 670 at Equifax, they're going to go off of the average of the 3. That's just always been kind of like the model and the rule that they use to kind of gauge what their, what their, credit scores are going to be and what the approval is going to be. So just to kind of give you, to go off of an average, it just seems to be the most, realistic option in a way for lending institutions, to qualify somebody on, how they repay their, their loans and their debts, is to go off of the average of the credit scores reported by the 3 major bureaus. Okay. So that's very important. Now, dispute inaccuracies. Okay, this is where we kind of get into, and we'll probably dig into this a little bit further in the continuing education class that we're having next month. But as you can see, creditors can make mistakes. If something on your credit report is wrong, contact the credit bureau and explain the discrepancy. They'll research it and make the needed adjustments, to the report. This may take a while, so the sooner that you initiate the dispute, the better. Now, what's important about disputing the inaccuracies is creditors, obviously they can make mistakes, but then sometimes they don't. Say for instance, there was something that happened in your past, and all of a sudden whoever the creditor was, puts it on your credit report saying, hey, you owe me this money. We're going to report to the credit bureaus until, you rectify this with us, those types of things. But in sometimes, the creditors are wrong. Say this was an account that you have paid, and you actually have proof of it, and they're still reporting it, and then you want to go in and file a dispute to try to get that rectified. The important thing when it comes to disputes are, during the mortgage process, you can't have any accounts that are technically in dispute unless they're medical. Those are the only ones that are allowed, that don't have to come out of dispute in order to complete the process. So if it's any kind of installment loan or anything like that, they don't have to necessarily, uh, you know, do it, I would say, before they want to get pre-approved, because, most of the time they don't even know until I tell them that's on the credit report that, hey, this is still in disputed. But for the most part, if there's any account that's in dispute, that has to come out prior to any kind of lending approval, because we just don't know how that's going to affect the findings. Okay, so normally what we do is if they don't know an account's in dispute, or if they do know, we send them a disputed account removal form where they can fill out, and they basically put in who the creditor is, and say that, hey, we are now removing this out of dispute. And then we send that over to the credit agency. They get it updated on the credit report. And then we run new findings with the credit report now being out of dispute to see if we still, or we do get a mortgage approval. So that's a pretty good important one to kind of understanding the credit report process and what people do and use that particular disputes for. Okay, and then number 6, lower your debt ratio. This is always a big one. Obviously, the less debts, the better. Obviously, so your debt to income ratio, can be the difference in your overall debt compared, to your income. The lower DTI, which is debt to income ratio, the better your chances are of getting a good mortgage rate. So let's kind of touch on this a little bit. Now, as far as debt ratio, what that is it's whatever are the minimum payments that you make that report to the credit report. So say, for instance, you've got a car loan that's, $300 a month, and you've got a couple credit cards. One of them is like $25 a month. One of them is like $80 a month, and so forth. And you've got a student loan that you have. The payment on a student loan, will say it's $100 a month. The ones that report to the credit report are the ones that are going to be factored in to your debt ratio, or the borrower's debt ratio, in order to qualify. So if you have, I would say, utility bills and things like that that don't report to the credit report, those are always good to kind of factor in your overall monthly budget and how, the borrower, plans. But I would say um, but for qualifying purposes, it's the things that report to the credit report. So, um, so we would add up all those minimum payments, and then whatever their new potential mortgage payment's going to be. Say their new payment's going to be $1,000, which includes their taxes and insurance and all of that stuff. We would add that to their minimum payments amounts, and then we divide that by their gross income. That's how you get, what your debt ratio is going to be. And for most conventional financing options, if the credit score is strong, you want to try to keep the debt ratio under like 45%. I've seen it go higher. I've seen it go up to 49% on conventional if the rest of the borrower's profile is very strong, which is maybe a larger down payment, or extra reserves, something like that in the that they have maybe in their accounts, whether it's checking, investment, or anything of that nature. So yeah, I would say that's really just the biggest thing in that regard, is just making sure you're knowing your overall debt ratio, what's going to qualify for. Now, there is a couple things that will get factored in to your debt ratio that are not on the credit report, but those are certain things like maybe child support or alimony, things like that, if it's not reported on the credit report, but by law, he or she is reported to pay that. Those kinds of things do have to get factored into the monthly debt ratio that don't report. So I just wanted to make sure and kind of touch base on that. Okay. We already kind of talked about no new debt, which is definitely important. So and avoiding opening up any new liabilities or things like that, especially I know it can get tempting. This is always a big thing, especially during the COVID years when everything was taking forever to get shipped out. A lot of people were trying to get furniture ordered. What I told clients is, you can use your current accounts that you have open. So if you had a credit card that you maybe had a little bit of room on and you wanted to order a sofa, but those kinds of things, okay, because it's already an open account that you have. It's not opening up a new one and having to have that updated on the credit report. So those kinds of things are okay. Once they let us know, we let them know, hey, okay, you should be okay, those types of things. And then lastly, obviously pay everything on time, which we kind of touched based on that as well. If you got in a bad habit of paying bills late, try to cut it out. That's what we tell our borrowers. Late payments result in extra fees and the negatively affect on the FICO score. So, those guys really are the biggest topics and the things that I like to discuss and go over in regards to, credit reports, and things like that. Is there any questions until I go into my kind of like our rapid rescore example and like kind of like what we do and what we, help process for clients? You guys have any, Danielle, or do you guys have any questions on the next steps or anything of what we went over? Everybody good? Okay. All right. All right. So here is a good example. Let me see if I can enlarge this a little bit more so you guys can see. Okay. All right. So here is a great example of what we do for borrowers, guys. When we pull a credit report, and we're looking at the borrower's credit score and we can see, okay, well, let's just check and see if there's anything that we can do to maybe help increase it. So this particular borrowers that I had, their credit scores that came, the first one you can see on there through TransUnion for applicant 1 was a 536. Underneath that, you'll see it says Experian, and their credit score through Experian was a 500. And then an example here underneath that one was that the third borrower score that they had was 479, and that was through Equifax. Okay, and the other co-borrower, the scores were a little bit better. They had a 693, a 634, and a 665. Okay, but as you can see on here, let me see if I can enlarge it just a little bit more. There we go. All right. As you look directly next to the credit report scores that are on there, it'll say potential score increase. Like this is what the rapid rescore is. It'll show you, it says potential for the first one, for the 536 score. It says potential scores, you could potentially go up to 601, which is a 65-point increase. And then the one underneath that, it's a credit score is 500. Potential score could go up to possibly a 570, which could be a 70-point increase. The 479 looks like it has a potential of going up to like a 566, which is an 87-point increase. So those kinds of things are exactly what the rapid credit rescore program tells us. It'll let us know, hey, if the borrower does A, B, or C, this could potentially move their credit score up, to that amount. And so now I'm going to scroll down and show you what the results are that came through. So let me scroll past these credit reports. We're not going to get all that. Okay. All right. So here it is. It says right on here, and this one is for Experian. Okay. It says, we have found a way to reach 580 or higher. And the likelihood of this going up would be 94% likely for their scores to go up to 580 if utilizing $11,726 to pay down 3 accounts as soon as possible. Okay. So as I scroll down a little bit more, it shows, here we go, Capital One Finance. Okay. So right now, the borrower's current balance was on the card note was $16,435. So if they were able to pay their balance of that car loan down to $7,850, that would help greatly benefit them in regards to their credit score. Okay. As I scroll down even more, the next account that's on the credit report, this Canton School credit union found that, account that they had, looks like the balance on this one was $2,564. Okay. And if they were able to pay that down to $10, that is going to help affect their credit score to get their points to go up. Next, as we scroll down here, oops, I went a little bit too fast. Sorry about that. There's that last one. There we go. Okay, this one was a Capital One account. Okay, so it says the balance on that current Capital One account was $760. And they said if you pay it down to at least a balance of $173, that is going to greatly affect, help with that 94% chance of the credit score going up to a 580. Okay. Next one here. There's another one here that I wanted to show you real quick too. But for this particular example, knocking down those three accounts itself will gives that borrower a 94% chance of at least getting their score trending towards 580 or higher. Okay, so this kind of stuff is very cool. It's very informative. It's very easy for borrowers to kind of look through and read and kind of gauge on what they can do on their own instead of having to pay for a credit repair person to go in and get those things worked on them for them. I mean, this is stuff that they can do on their own fruition, and then once they get those accounts paid down to these balances, so for the Canton school amount, the 2464 paid down to $10, and the Capital One finance paid down to $7,850. Once they're able to get us a statement that shows the balances are now those amounts, what we can do is we can actually go on their behalf and reach out to the credit agencies and go over all those kinds of things with them to show them, hey, look, this is what the borrower did. Here's the proof of funds that they used. Here's the balances. Please enter this in the rapid rescore calculation so they can, see what can happen and how their credit score can be adjusted. And we do all of that on their behalf. It helps save a ton of time because normally if they're able to pay these things down quick and get us these statements, we can go into the credit bureau and the wait process may be only 7 to 14 days as opposed to 3 months. You know what I mean? So it's definitely a lot faster when we're able to help borrowers do that. Going directly to the credit agencies, just due to our relationship with them. Okay. The next example on here, this was another, let me see if this one was pretty, no, this one was different options. Okay, so this one was with TransUnion. Okay, and on here it says this is going to be a 97% likelihood that the credit score will reach 580 or higher if they do these. Now, this particular option was different. This one, they only needed about $3,400 in order to, pay down or pay off, the accounts in question to help, get the credit score to increase. All right, so this particular one was a Canton school. This probably was some kind of installment loan, maybe a car loan or something like that, or a personal loan. It looks like the current balance was $25.64. If they were able to pay that down to $10, that'll help, get that credit score, moving towards the 580 mark. Here's a Discover Bank account that they had. Looks like their current balance was $793. With them paying that down to a balance of $10, it's going to move the needle in their benefit. Okay. Now we have the Capital One account. Pay the balance down from $760 to $603. See, that wasn't a huge amount they had to pay on this one, and it was enough to help move the needle. So doing those three things, like I said, would give them the ability to have a 97% chance of their score being at 580 or higher. So at least it's starting to trend in the right direction, possibly for them being able to get pre-approved for a mortgage, even if it's FHA. I mean, I've gotten 580 credit score FHA borrowers approved, all the time. In some cases, they may have to put a little bit more down, those kinds of things, but at least they're able to, get a mortgage, and get something that they're happy with. And so it gets them into the house and gives them more time to then maybe, work on getting their credit report. And then when it comes time to refinance, they may be able to refinance out of that FHA loan into maybe a conventional loan product where they may not have PMI anymore. So lots of good things to kind of, see and kind of go over. Okay. And let me see, I'm going to try to find. that other thing that I wanted to go over real quick. Another one. If I saved it. Oh, well, it's all right. No problem. All right, so I'm going to stop sharing here real quick. All right, guys. But other than that, that's it on credit repair that I really wanted to kind of discuss. And I know briefly we have a few more minutes here. I wanted to kind of touch base on, consolidations and things like that. I always have a lot of borrowers that ask me, okay, so what are the benefits of consolidating, and is it smart? Do we put it in with our mortgage, or how do we do these things? And so, and I tell them, I'm like, look, your home is always going to be your number one asset. And if you have the equity in it and it helps relieve monthly liabilities as a whole for you to kind of, get caught up and, get a manageable type of payment, then absolutely consolidation could be in the right choice for them. Now, depending upon how they do it is another thing. So, for instance, if you've got a borrower that already has maybe a really good first mortgage interest rate, say they're one of the lucky ones that got a mortgage back in 2020 when rates were 3%, and they don't want to touch that. I'm like, okay, that could be probably a smart move to leave that mortgage the way you have it because the interest rate on it's so low. But maybe so let's look and maybe look at a home equity line of credit or something like that, because there are fixed options. I know here at CrossCountry we have a fixed home equity line of credit option where the rate will be fixed for the duration of whatever that loan is going to be for them. So in most cases I have them, I'm like, okay, well, look at everything you want to consolidate, see what's the interest rate on what you're paying too, so let's add them all up. So in most cases it's not just a monthly saving, it's actually an interest savings too. So most cards that I see people wanting to consolidate and pay off credit cards are like, my goodness, north of like 18 to 20%. So what I tell them is that I'm like, get all of your accounts and see what the interest rates are, see what the payments are. We're going to add up all the payments together, and then we're going to add up all the interest rates together and get what your blended interest rate was. So in one case, I had this client that I think, they actually included their first mortgage into the refinance because they just wanted to have one loan. They didn't want to do the home equity line of credit, which is fine. They wanted to just refinance everything into their first mortgage. And this was a few years ago. And I think at the time, their rate was, before we refinanced, it was maybe 6.9%, something like that. So what we did was they wanted to pay off all of their credit cards. They paid off a car loan, I think that was one of their kids, so they could get all, they just were trying to get ahead. And when I added up, not just the monthly minimum payments that they were making, I was adding up all of the interest rates on all of the accounts that they had. It was, it was unbelievable. And, the blended interest rate of everything that they were paying out each month. So even with their mortgage rate being at a 6%, and their credit cards being at a 19%, once you added them all up, I think the blended interest rate for their overall debt was like 10%, because the interest rates were so high on the other accounts that they just weren't making a dent. They were just paying that monthly payment each month, but not seeing that balance go down. So that's where debt consolidation can make some sense. Because after we consolidated everything for them and put everything into their mortgage loan, and I think at that time it was a rate of 5.75. So I think it was a full percent less in mortgage, but now this payment was wound into their, and I think we actually did a 20-year mortgage. It wasn't even a 30-year. It was like a 20-year loan. And just by doing that, it saved them their monthly obligations going out each month about $600 a month. And now they're paying 5% interest on, that debt, as opposed to 6%, 10, 13, 19 on all the other accounts that they have. So in some cases, debt consolidation can be very impactful and very positive for, the borrower's, situation. So we always like to make sure to let everybody know that, hey, this is why we're here, is to help educate and talk to people and let them know that, hey, if there's anything that's out there that we can help them with, and consolidation if they have questions, and we can maybe do it either with a first mortgage or with a home equity line of credit. We like to make sure that we talk to them about that and talk through that with them so they can see. So, but other than that, guys, that's pretty much it that I had for today. I wanted to make sure and touch on these great topics. And if you have any questions, or if there's any of this information that I went over today, I can always get you a copy of it. If you do want any of that, let me know. I'd be happy to share that with you. And if there's any questions, just let me know. But thanks for coming today, and make sure to come, next month. I think that's going to be really, really good and very informative. All right. Take care.